Imagine you check your retirement account balance online. It shows $250,000. You feel secure. Then a financial advisor pulls up a different screen, one you have never seen before, and says, actually, your account is linked to $42 trillion in obligations that nobody is tracking. Not your bank, not the government, not even the people who created them. You would think that is impossible. This is America. We have regulators. We have audits. We have the Federal Reserve. Everything was supposedly fixed after 2008. Banks hold more capital now. Stress tests get passed. The system is transparent, except it is not. There is a second ledger that nobody shows you. A parallel financial universe roughly 3 times the size of the entire US economy, operating in the shadows, building leverage in places regulators do not supervise, through instruments they barely understand. $42 trillion that exists and does not exist at the same time. When the International Monetary Fund and the Bank for International Settlements both admit in official reports that they cannot see roughly half of what is happening in global finance, they are not being modest. They are telling you the altimeter is broken. So where did $42 trillion go? And what happens when it comes back? Let me show you how this works in practice. Every major bank in America publishes financial statements that regulators review, that analysts scrutinize, that investors rely on to make decisions about where to put their money. These balance sheets show assets, liabilities, capital reserves. They tell you what the bank owns and what it owes. But here is what they do not show you. In 2007, right before the financial system collapsed, the 4 largest depository banks in the United States had moved $5.2 trillion in assets and liabilities into special purpose vehicles that did not appear on their primary balance sheets. $5.2 trillion. That is not a rounding error. That is not a footnote. That is an entire parallel banking system operating outside the view of anyone checking the published numbers. Fast forward to today, the Financial Stability Board, the global body tasked with monitoring systemic risk after 2008, now tracks $250 trillion in what they call non-bank financial intermediation. That is the polite regulatory term for shadow banking. Entities that act like banks, lend like banks, create leverage like banks, but are not supervised like banks. $250 trillion. For context, that is roughly 3 times global GDP. And here is the part that should terrify you. The FSB admits in its official reports that roughly half of the funding sources for this sector remain unaccounted for in aggregate statistics. They are publishing numbers while simultaneously telling you they do not know where half the money is coming from. The comfortable story you have been told goes like this. After Lehman Brothers collapsed in September 2008, regulators fixed the system. They implemented Basel III capital requirements. They stress-tested the banks. They created the Financial Stability Board to monitor global risks. They tracked the derivatives market, which now stands at $718 trillion in notional value. Everything is transparent now. Everything is under control. Except the people doing the monitoring keep telling you it is not under control. The Bank for International Settlements, the central bank for central banks, stated explicitly that understanding of banks' international positions falls far short of what is needed for sound monitoring. The International Monetary Fund acknowledges that interconnectedness of non-bank financial institutions with the rest of the financial system is increasing, but the opacity of those connections remains significant. These are not conspiracy theorists. These are the official institutions responsible for preventing the next crisis. And they are telling you in dry, bureaucratic language that they cannot see what they need to see. Here is what actually happened after 2008. Regulators tightened rules on traditional banks. They raised capital requirements. They limited leverage. And the financial industry did exactly what you would expect. It moved. The same activities that caused the crisis did not disappear. They migrated to entities that face lighter supervision. Shadow banking grew from $67 trillion in 2012 to $250 trillion today. That is 8.5% annual growth, more than double the 3.3% growth rate of traditional banking. The risks did not shrink. They relocated. And this time, they are bigger, more complex, and spread across more jurisdictions where no single regulator has comprehensive authority. So how exactly do you hide $42 trillion? Let me walk you through the mechanisms. The first technique is something called a special purpose vehicle. Before Enron made these infamous, they were standard accounting tools. Here is how they work. A bank originates $10 billion in mortgages. Under normal circumstances, holding those mortgages on its balance sheet requires regulatory capital. Capital is expensive. It reduces returns. So instead, the bank creates a legally separate company, sells the mortgages to that company, and because this entity is technically independent, those $10 billion disappear from the bank's balance sheet. The bank typically provides a liquidity backstop, a promise to step in if things go wrong, but that promise does not show up as a liability until it gets triggered. When the crisis hit in 2008, those off-balance sheet obligations came crashing back. Bear Stearns had sponsored special purpose vehicles holding mortgage-backed securities that collapsed in value. Lehman Brothers maintained hundreds of these entities with inadequate documentation. The remote bankruptcy protection everyone assumed would hold evaporated instantly. The assets were off the books until suddenly they were back on the books at the exact moment when banks had no capacity to absorb them. The second mechanism is derivatives. The Bank for International Settlements tracks over-the-counter derivatives at $718 trillion in notional value as of mid-2024. But here is the accounting trick. Banks do not report that full notional value on their balance sheets. They report only the much smaller fair value, which fluctuates based on market conditions. In mid-2022, during interest rate volatility triggered by inflation and the Ukraine war, the gross market value of these derivatives surged 47% in 6 months, from $12.4 trillion to $18.3 trillion. Interest rate derivatives alone jumped 32% year over year to $11.8 trillion. Euro-denominated contracts increased from 3.1 trillion to 4.4 trillion in just 6 months. These are not hypothetical numbers. This is actual money at risk in counterparty relationships. Before 2008, credit default swaps, essentially insurance contracts on debt, grew from almost nothing to over $60 trillion with no capital reserves required. AIG sold over $500 billion in these swaps, collected fees, and held zero capital against potential claims. When the underlying securities lost value, counterparties demanded over $100 billion in immediate collateral. AIG did not have it. The Federal Reserve had to provide $182 billion in bailouts because AIG's failure would have triggered cascading defaults across the entire global banking system. The third mechanism is shadow banking itself. This sector is not called shadow banking because it operates illegally. It is shadow banking because it performs banking functions, lending, maturity transformation, leverage creation, outside banking regulations. The sector has exploded from $28 trillion in 2009 to $250 trillion in 2023. These entities, money market funds, hedge funds, private equity firms, structured investment vehicles do not have banking licenses. They do not take FDIC-insured deposits. They are not required to hold the same capital reserves traditional banks hold. Yet they lend. They create leverage. They generate systemic risk. When Reserve Primary Fund broke the buck in September 2008, unable to maintain its $1 share price because it held $785 million in Lehman Brothers paper, it triggered a run on money market funds. $300 billion in withdrawal demands hit within 48 hours. The commercial paper market, where corporations borrow for short-term operations, seized completely. The Federal Reserve had to create emergency lending facilities to prevent economic paralysis. Now let me show you how these hidden liabilities actually detonate. September 15th, 2008, Lehman Brothers files for bankruptcy. Within hours, not days, hours, global credit markets freeze completely. The question everyone asks is why? Lehman was the fourth largest investment bank, yes, but it was one institution. Why did its failure paralyze the entire financial system? The answer is interconnected opacity. Every bank suddenly questioned every other bank's exposure. If Bank A had lent money to Bank B, and Bank B held derivatives contracts with Bank C, and Bank C owned securities from a Lehman-sponsored special purpose vehicle, what was Bank A's actual exposure? Nobody knew. The interbank lending market, where banks lend to each other overnight to manage daily operations, froze. JP Morgan Chase stopped clearing Lehman's transactions, over $100 billion daily. The web of off-balance sheet commitments, derivatives positions and shadow banking linkages created complete systemic paralysis. Banks that appeared solvent on paper could not prove it, because nobody could see the full extent of anyone's obligations. Here is what the official record shows. Timothy Geithner, who was president of the New York Federal Reserve at the time, catalogued the shadow system before the crisis: $2.2 trillion in asset-backed commercial paper conduits and structured investment vehicles, $2.5 trillion in overnight repo financing, $1.8 trillion in hedge funds, $4 trillion across 5 major investment banks, none of it fully visible in traditional banking statistics. When the system seized, the Federal Reserve, the European Central Bank and other central banks had to provide over $10 trillion in emergency liquidity because they could not determine which institutions were actually solvent versus simply unable to access funding. The fundamental problem was that consolidated global bank positions were not fully reported. The IMF and BIS now state explicitly that publicly available information on individual banks' international positions falls far short of what is needed for sound monitoring. Currency mismatches, maturity mismatches, counterparty exposures, all either underreported or aggregated beyond any useful level of detail. The fifth mechanism that makes all of this possible is regulatory arbitrage. Banks operate under capital requirements that make holding assets expensive. The solution is to move those assets off the balance sheet through legal structures that technically separate risk while maintaining economic exposure. This is not fraud. This is optimization. Post-crisis regulations tightened requirements for traditional banks, so activity migrated to shadow banking. The Financial Stability Board's 2024 report shows that fixed income funds and mixed funds display high degrees of liquidity transformation. Finance companies, broker-dealers, and structured finance vehicles show relatively high levels of leverage, same risks, different entities, lighter regulation. In 2024, major banks announced billions in commitments to private credit funds. JP Morgan set aside $10 billion. Wells Fargo partnered on a $5 billion direct lending fund. Citigroup launched a new vehicle specifically for private credit solutions. Michael Hsu, the acting head of the Office of the Comptroller of the Currency, warned publicly that banks raising exposures to the lighter regulated shadow banking sector creates new systemic risks. The cycle repeats. Regulations push activity into less regulated spaces. Risks accumulate invisibly, and the next crisis emerges from blind spots regulators have not yet mapped. Elizabeth McCall from the European Central Bank stated in 2024 that shadow banking operates outside the banking supervisory and regulatory perimeter, and the nebulous links between this sector and traditional banks through repurchase agreements, lines of credit and derivatives spark concerns about what this translates into for systemic risks. She is not speculating. She is describing current reality. So where does this leave us right now in 2024? The shadow banking sector commands $250 trillion, 49.1% of total global financial assets. Derivatives stand at $718 trillion in notional value. US bank loans to shadow banking entities exceed $1 trillion. These are not theoretical risks building slowly in the background. These are active exposures that grow larger every quarter. Money market funds saw explosive growth in 2023, driven partly by higher yields compared to bank deposits, but also, and this is critical, by the March banking turmoil when Silicon Valley Bank, Signature Bank and First Republic all collapsed within weeks. When depositors fear bank stability, where do they move their money? Into shadow banking. Money market funds that lack FDIC insurance but offer higher returns. This is procyclical behavior at its most dangerous. The very moment traditional banks face stress, money flows into less regulated alternatives, amplifying the crisis instead of dampening it. Real estate investment trusts, finance companies, broker-dealers, and structured finance vehicles show the highest financial leverage in the non-bank sector right now. Meanwhile, metrics for liquidity transformation in fixed income funds remain elevated, meaning these funds are borrowing short-term and lending long-term, the classic setup for runs when funding disappears. The derivatives market provides another flashpoint that is building in real time. Yen-denominated foreign exchange derivatives grew 26% in yen terms during the first half of 2024, as Japan finally exited negative interest rates and markets speculated on normalization. Commodity derivatives linked to oil expanded 18% year over year. Each spike in volatility increases gross market values, and with them, counterparty risks. In mid-2022, remember, gross market value jumped from 12.4 trillion to 18.3 trillion in just 6 months. That volatility has not disappeared. It is waiting for the next trigger. The most concerning element is regulatory fragmentation. Shadow banks operate across borders and sectors, regulated by different authorities with different standards and often no standards at all. A hedge fund registered in the Cayman Islands, funded by a German bank, trading Japanese yen derivatives and holding US corporate debt faces no consolidated supervision. The Financial Stability Board calls for enhanced oversight in every annual report. Implementation remains patchwork. Cross-border linkages between traditional banks and non-bank financial institutions have risen dramatically, yet the IMF continues noting that large data gaps remain. The Bank of England announced system-wide stress tests in 2024, specifically examining potential concentrations of risk exposures at certain banks to shadow banking. Why now? Because regulators know what the data shows. Exposures are growing faster than visibility. S&P Global Ratings has warned that lagged effects of past interest rate hikes will likely constrain economic growth and tighten funding conditions in 2024 and 2025. That is exactly the environment where hidden leverage and liquidity mismatches detonate. Future crises will not announce themselves with press releases. They will emerge from interconnections nobody fully mapped. A private credit fund defaults on loans from multiple banks, or a major broker-dealer cannot roll over its repo financing, or a derivatives counterparty fails, triggering cascading margin calls across institutions that thought they were hedged. The 2008 playbook remains the same. An obscure entity fails, interconnected exposures crystallize, funding markets freeze, systemic panic follows. We fixed the problems we could see after Lehman. The ones we cannot see are still growing, still hidden, still building toward the next breakdown that regulators will claim nobody could have predicted. So what does this mean for your money? When Lehman Brothers failed, it was not just traders on Wall Street who paid the price. Pension funds held Lehman bonds. Money market funds held Lehman commercial paper. Ordinary savers who believed they had safe liquid investments watched their accounts freeze. Retirement portfolios collapsed. The Dow dropped 4.5% in a single day. $700 billion in market value vanished. That was the visible damage. The invisible damage lasted a decade. Near zero interest rates that destroyed returns for retirees living on fixed income. Over $10 trillion in central bank interventions that inflated asset prices beyond the reach of average workers. And a fundamental erosion of trust in the financial system that persists today because everyone knows the underlying problems were papered over, not solved. For those of you approaching retirement or already retired, the implications are direct and personal. Your bank deposits are FDIC insured up to $250,000. Everything beyond that depends on counterparties you cannot see, in markets you cannot access, with exposures no one fully understands. When shadow banking entities face runs, traditional banks provide backstops. Those backstops become your problem when central banks intervene to prevent systemic collapse. The 2008 crisis taught one lesson with brutal clarity. Official assurances mean nothing when hidden liabilities surface. Bear Stearns went from solvent to insolvent overnight, not because its loans went bad, but because funding evaporated. Liquidity is confidence. Confidence evaporates when balance sheets hide more than they reveal. The financial system operates on two fundamental principles, leverage and opacity. Banks maximize returns by maximizing leverage, borrowing to amplify profits. They maximize flexibility by moving liabilities off balance sheets, reducing regulatory capital requirements. Shadow banking entities do exactly the same thing, but with even lighter oversight. The result is a system where everyone claims low risk because regulations measure visible capital against visible assets, while the real action happens in derivatives, special purpose vehicles, and non-bank entities that regulations barely touch. You cannot opt out of this system. Your money market fund likely holds commercial paper from shadow banking entities. Your pension fund has exposure to private credit. Your bank has commitments to broker-dealers and hedge funds. The interconnections are structural, not incidental. Here is what you can do with this information. Accept that official statistics understate risk. The Financial Stability Board's $250 trillion in shadow banking, the Bank for International Settlements $718 trillion in derivatives, these are lower bounds. Half the funding sources remain unmapped. When the IMF says data gaps persist, believe them. Diversification matters, but not the way Wall Street sells it. Geographic diversification is meaningless when crises are global. Asset class diversification helps but does not eliminate exposure to systemic breakdowns. What matters is liquidity, counterparty quality, and understanding what you actually own. If you cannot see the underlying exposures, and with most financial products, you are taking blind risk. Maintain cash reserves outside the financial system. Treasury bills and bonds offer direct government exposure without bank intermediation. Physical assets, real estate, commodities cannot be rehypothecated or disappeared through accounting manipulations. Gold remains the hedge against systemic uncertainty precisely because it has no counterparty risk. Most importantly, recognize that financial crises are not anomalies. They are features of a system built on leverage, opacity, and interconnected risk. 2008 was not solved. It was papered over with central bank money. The structural vulnerabilities remain, larger, more complex, and spread across more entities that regulators do not supervise. The financial system will face another crisis. The liabilities no one tracked will surface. The exposures no one mapped will crystallize, and wealth will be destroyed not by the announced risks but by the hidden ones.